Robin Marshall is the Director of Fixed Income at Smith & Williamson Investment Management, and he joins me now. Robin, what I've really been taken with your views is, of course, for quite a while now, you've felt that Greece will in fact exit the euro.
Yes.
Do you still believe that, and how is that really going to help matters? Would that not just stem contagion?
Well, yes, there's no easy solution to this, Caroline, as you say, so it's going to be a difficult transition, whatever happens. The problem I have with Greece staying in is that there's no future. There's no future for them, and there's no future for the countries that will need to pay for Greece staying in through the fiscal transfers. Because if you look at the drill down and see the underlying economy's performance, the adjustment in competitiveness that's required for Greece to stay in simply hasn't happened. And they've run out of time now. They've run out of money and they've run out of time.
But clearly there is fear in the markets that if Greece leaves, then what happens to Portugal, what happens to Ireland? This is really why we've seen such a fight by Merkel, Sarkozy to try and keep Greece in the euro, really taking some quite shock tactics to try and either force a decision one way or another. How would that actually help the markets? Because clearly we are seeing them in some sort of turmoil at the moment.
Yes, I take your point. I mean, there's a contagion issue here for the rest of Europe, the rest of the Eurozone, and indeed the rest of Europe. But it strikes me that if you make the separation, for Greece, there's no future staying in. And in fact, it's a very bleak future that you look at. And I think it's no surprise now that there's pressure for a referendum. There's a big popular revolt developing. And actually for them, the sooner they leave, the better, because then they can get on with a big exchange rate devaluation. They will become more competitive. There's some future hope of unemployment coming down. But for the other countries, of course, they're desperate about the contagion effect. So your point's well made. But if they stay in, we're going to go through one crisis after another in the next 6, 12, 18 months before they finally leave, because I cannot see this as sustainable.
And what about Portugal and Ireland? What will happen to bondholders now? We're seeing so much pressure on the bondholders.
Well, I think you're right to say that Greece may well not be the last country to leave. Yeah. I mean, once you open the trapdoor for Greece and find an exit route, probably Portugal will go. Ireland has made a lot of competitiveness adjustment and can probably stay in. Yeah. But there will have to be haircuts for bondholders. There will have to be a lot more recapitalisation of the banking system. There are no two ways about that. But it's going to be a much slimmer euro when we're finished.
Wanted to get your views really on how to dissect these numbers, because is it much of a boost to see it coming down from 9.1% to 9% in terms of unemployment rate?
No, and I think you need to look at the participation rate as well. I mean, that's at a 25-year low, or virtually at a 25-year low. So a lot of people there are signs that people have given up and left the labour force. And as your colleague was saying, we also have this high proportion of long-term unemployed. Yeah. So there's a real issue, I think, about whether the natural rate of unemployment has moved up. You know, in the Goldilocks period, we were used to the natural rate, if you like, being down at 5.5. In other words, the non-inflationary level of unemployment. It now appears the economy has moved to a higher level of unemployment consistent with stable inflation. So the Fed's going to have to accept probably slightly higher inflation if it's to get the unemployment rate down. And the other problem is, despite what President Obama's been saying, he has very little room on the fiscal side, given congressional opposition as well, to do a kind of Keynesian counter-cyclical demand management exercise. So the onus is going to be on the Fed, and that's going to mean a higher inflation rate, probably, if they're to drive unemployment down a bit further.
And with 80,000 being added, how can we bring that down to 8%? And how can the US convince employers really to start hiring again? Because what's actually delaying this hiring? Is it, in a certain extent, the European debt crisis?
Well, I think that's not helping, but I think there is a real fear about deficiency of aggregate demand going forward, and consumers deleveraging. Because if you look at it, in the third quarter, we did get 2.5% growth, which is a little bit better than the sort of 1% print that we had for the first half of the year. But that was financed by a reduction in the savings ratio from 5 to 4% of income. So consumers are struggling to sustain consumption growth, and if anything, they're paying down debts rather than expanding consumer expenditure, and that's going to be a real problem. So although we may not dip into recession, it looks like we're going to be condemned to these low growth rates for some time, and the Fed will probably have to do QE3, QE4.
And in a way, that deleveraging, it's a problem, of course, for the unemployment rate and for indeed demand and consumption. But something that really has to happen.
Yes, I think that the problem is with these balance sheet driven recessions, they take a long time to recover from. So it's wrong to expect this to be a swift cyclical recovery. You know, we've been in this now for 3.5 years, and we're still only managing growth rates of 1-2 if we're lucky. So compared to the sort of V-shaped recoveries we had in the 70s and 80s, this is pretty grim stuff and will probably persist for some time yet.
And indeed, in talking of persisting performance in the economy, 3.5 years financial crisis, well, 2 years crisis in Greece. Are we going to? What do you want to see coming out of the G20 in terms to breathe some sort of confidence back to the markets? Can anything be said to bring confidence back to the markets?
Well, I think if they're going to continue with this pretext that they're able to keep the Eurozone in its current form, I don't think that's going to do a lot for confidence in the medium term. And I think the markets are slowly but surely coming around to the realisation that cutting Greece free and going through a difficult period of transition, admittedly, is the best solution in the medium and longer term. And you know, only in that way will you get a proper recovery. It's going to be tough, however you do it, but trying to keep this system together and patch it up with ever tortuous financial engineering, to me, is no steady state, and that's not the way to faster growth down the road.
Robin Marshall, thank you very much for your time and all
Pleasure.
your insights you've given this afternoon.